Rich Saperstein, last time you were with us, you were still optimistic. Brenda's trying to remain optimistic, looking at the stocks that have gotten pummeled and looking for opportunity. What about you today? Have you changed your point of view? Have you been buying some of the stocks that you had your eye on before?
No. So in the last 38 years, the average correction has been about 14% a year. And in 29 of those years, the market finished higher. So when we look at our equity exposure, which, by the way, we have three components to client portfolios. We have equities, bonds, and non-market related securities. The equity component right now represents around 55% of our client assets. In terms of what we're doing...
Versus traditional levels, just give us some perspective.
It was about 55% all year, okay? But we have the bonds in the portfolio, which act as ballast and gives us the ability to take that asset and reinvest into equities when they become attractive. And that's exactly what we're going to be thinking about doing in first quarter of 2019, when the valuations present itself and when this market finds a bottom.
Yeah. I mean, Mike Wilson, for all of, the sort of if you could take it negative that, he says we're in a bear market, but what about this view that it's maybe a reality check for everybody who's gotten overly negative, thinking that the end of the world's coming again? What about his point of view? Close to the bottom, we're not going down like another,
right,
20, 30, 40%, anything like that. You're going to stabilize into maybe the middle of next year.
So I don't see it as an end of the world, and I've been as negative as you have, maybe a little more. I've been sitting 75% cash for a long time. And I've actually increased the cash as we've popped. But so I just think it's a resetting of what, frankly, a lot of people that are in the market haven't ever been in the market, and all they know is the market going up. So they need the reality check. I thought that valuations really got stretched in the market.
And now, they've come back down to earth.
They've come back. And
are they still expensive, as Schiller said on our air earlier today?
No, I don't think. I think some are still expensive. Yes, absolutely, on a relative value, because you've had some like Visa. I own Visa. Visa to me is just now hit an historic multiple at this point. Maybe it's even a shade higher, so it's got to come back. So you can't really take a look. The problem that everybody's having, in my view, or the issue, is that they're looking at stocks and benchmarking to where the market was at the absolute top, when everything was rosy, everything was going great, and there was no reality to that. So you have to overshoot in terms of what a fair value is. We're starting to do that now. To me, the risk reward is still not attractive, depending upon your time frame, going in now. I'd rather wait till we see that actual consolidation before I start deploying capital. As a matter of fact, I don't think there's any asset class right now that's attractive. And I can go through all of them.
You don't have to. I mean, it was a terrible year to make money in almost anything.
People were putting money to work in real estate with zero cap rate, maybe 2%, and hoping to flip it. So that doesn't make for an attractive market.